Welcome to Perspectives with Wenchi Yu, where we discuss Trump 2.0's policies and politics and their implications for Asia, China, Taiwan, and beyond. In a Chinese Communist Party Journal article dated January 30th, China's President Xi Jinping reportedly said that advancing renminbi internationalization is essential to China's goal of becoming a financial great power. While Trump 2.0 is pursuing a weak dollar policy, seeing a cheaper dollar as a way to boost exports, support U.S. manufacturing, and shrink the trade deficit, many economists believe China has long kept its currency undervalued as a core tool to maintain export competitiveness, limit domestic consumption, and prioritize manufacturing growth. To understand one of the levers of China's economic rise, we're speaking to the UK-based economist, Stewart Paterson. Drawing on his decades of experience in Hong Kong, Singapore, and London as a China-focused hedge fund manager and author, Stewart walks us through how Beijing has systematically used its currency to supercharge manufacturing, amass foreign exchange reserves, and reshape global trade patterns. Stewart argues that a political economy driven by the maximization of national power, that is the Chinese system, cannot easily coexist with market-driven systems organized around consumer welfare. And this fundamental mismatch is now showing up in everything from smartphone supply chains to Europe's auto industry. Let's hear Stewart's perspective. So welcome, Stewart. Thank you so much for joining us. We're really excited about today's episode, which is really going to focus on RMB, a topic of great interest to the world. But before we start, maybe we can have you share a little bit about your personal experience and background when it comes to Hong Kong and China and finance.
Yeah, of course. Well, first of all, thank you very much for having me on the podcast. It's a pleasure to be here. My interest in China goes back a long way. I first went to Hong Kong in the late 1990s in a role in investment banking, analyzing the Chinese economy and regional markets. And, I was there really when China receded to WTO and the whole globalization of the Chinese economy took off. And I had this sort of bird's eye view overlooking the Lama Channel from my flat, watching the container ships go out full and come back empty. And that was really the inspiration for writing my book, China, Trade and Power, Why the West's Economic Engagement with China Has Failed. And, since that book was written.
And that was published in what time?
That was published in 2018. So before really the West or liberal democracies started to push back against Chinese mercantilism. But obviously since then, the economic engagement with China has become more selective, shall we say, more conditional, and clearly much more political, both domestically and in the international arena. And so subsequent to writing that book, I became a research fellow at the Heinrich Foundation, and I consult also, the Chinese economy and the geopolitical ramifications of China's economic globalization. And so that's really where my interest in the internationalization of China's financial system and the RMB stem from.
So you were in China from the late 90s until when?
I left in 2007, just before the global financial crisis, to move to Singapore when I set up on my own, running a macro hedge fund there.
And then you were in Singapore from 2007 until
2012, and that's when I returned to the UK.
So during that time, were you already thinking that the world's engagement with China's economy needs to be reconsidered?
Yeah, particularly the framing of it. The great expectation was that with greater trade and interaction with China, that China would become a responsible player in the global economic system. But I think it was fairly evident in the early 2000s, a couple of years after WTO accession, that liberalization, economic liberalization, was only going to go so far, that the party state's grip on the commanding heights of China's economy was going to be maintained at all costs, because the party state, quite rightly, I think, see control over the allocation of resources as being key to its survival. So I think the approach was flawed really from the start. That's not to say that it wasn't worth giving it a go. But once it was evident that it wasn't succeeding, I think a reappraisal was very necessary. And it's taken us obviously a long time to get there. And that's come at a huge cost, obviously, because the multilateral trading system really appears to be on its last legs. Not all the blame can be laid with China, but quite clearly, since the big RMB devaluation of the early 90s, China has run perennial current account surpluses, has maintained an exchange rate that has been artificially depressed and is now about half of purchasing power parity, and has maintained very high levels of both direct and indirect subsidies to its manufacturing base. A part and parcel of that mercantilism has been the suppression of domestic consumption and therefore the suppression of demand for goods from outside China. And so this asymmetry of behavior has taken its toll. And now what we see, of course, is countries outside of China are behaving much more like China in terms of embracing industrial policy, greater use of tariffs.
Let's focus on China for now. I thought it's interesting that you were saying the devaluation of RMB has always been intentional as a tool to boost China's manufacturing and export power. So let's dive deeper in terms of how Beijing has been able to use its currency for its economic goals.
Oh, so it was the early 90s. It was the end of 1993 with the first big devaluation. At that stage, the RMB was chronically undervalued. China ran a current account deficit in 93 and a surplus in 94. So 93 was the last year in which China ran a current account deficit. The big effect of an undervalued exchange rate is obviously that your exports are more competitive and imports are more expensive. And particularly when you've got an exchange rate is that undervalued. And in addition to that, our spending and estimates vary, but some are as high as 7% of GDP on direct and indirect subsidies to your manufacturing base. Clearly, they're going to be highly globally competitive. Now, obviously, that competitive position manifests itself in these big trade surpluses, and in the normal course of events, the repatriation of those foreign earnings by the exporting companies would drive the RMB higher. But, in those early days, what happened was the PBOC was willing to step in to maintain what was in fact a peg at that stage and a fixed exchange rate, and then more recently a sort of floating peg, a crawling peg. And that was the genesis of China's huge foreign exchange reserves. And then, more latterly, particularly after the sort of 2014, 2015 hiatus in the exchange rate and markets, the burden of preventing RMB appreciation has fallen much more heavily on the commercial banks, or the so-called commercial banks. I'm talking about the big state-owned lenders there, who have taken over from the PBOC in terms of accumulating this foreign exchange. The two big policy banks, China Development Bank and Export-Import Bank, which probably have a fairly similar size of net foreign asset exposure, which isn't declared, of course. So, the burden, if you like, of maintaining an undervalued currency has been shifted from the PBOC to the banking sector.
Beijing also hopes to use and leverage its RMB, including the RMB globalization. When did that thinking start, and how have they been pushing the RMBs, and have they been successful?
When China started to engage with the rest of the world, economically speaking, and initially, China lacked any kind of foreign exchange reserves and therefore backing for the RMB. And it made perfect sense for them to accumulate large quantities of foreign exchange reserves that the PBOC would hold. And these were largely just US treasuries, i.e. safe, liquid assets, which gave the RMB backing and gave the market some confidence in the value of the RMB. Moving forward, once those foreign exchanges reserves have been built, it didn't make much sense geopolitically for China to be effectively bankrolling the government of the United States. The PBOC were taking the foreign exchange earnings that the exporters were making and recycling them into US government debt, therefore facilitating what some would call the profligacy of the US government. Others might call it the expansionism of the US government and its military machine and what have you. What you saw really with the Belt and Road Initiative, the beginnings of that, was this massive asset allocation shift, that the foreign exchange reserves the foreign exchange earnings that the exporters were generating were now being recycled via China Development Bank, Export-Import Bank, CIC, China Investment Corporation, the various Silk Road funds, etc. Physical infrastructure assets and soft infrastructure assets. And so that was really the beginnings of it. But then when you looked at the rising geopolitical tensions between China and much of the rest of the world, particularly the way the United States had used the role of the dollar in the global trading system against countries such as Venezuela and Iran in terms of sanctioning and cutting them off from the dollar system. I think that's where it became very evident to the Chinese authorities that they needed an alternative international payments architecture to make themselves safe from the threat of US sanctions. So the initial move into internationalizing the RMB was very much a defensive one. It was driven by a fear of being on the wrong side of US sanctions, and China quite clearly wanted to put themselves in a position where they were immune to that kind of pressure.
So it was an alternative. It wasn't really trying to become this global currency in the world. Is that what you were saying?
Correct. China's capital account is the exchange rate is not fully convertible on the capital account. The Chinese wish to control capital outflows from China and also foreign flows into China, which is why you have this alphabet soup of acronyms around the exchange rate. You have two exchange rates for a start, right? You have the CNH and the CNY. You have an offshore RMB and an onshore RMB. That's for a reason, right? You have SAFE, the State Administration for Foreign Exchange. You have, these quota systems for access to Chinese equity markets and bond markets. You have capital controls on the way out of China, with the per capita limits of how much money can be taken out of China. And you need safe approval, other regulatory approvals for investing outside China if you are a Chinese entity. So all these barriers to the free flow of capital in and out of China are testimony to the fact that, the RMB is not fully convertible. If you were serious about setting out to actually replace the US dollar as a global reserve currency, you would be unwinding these capital controls, because it's impossible to be a global reserve currency if you have these sort of capital controls in place. And, if you look at the progress that has been made in the internationalization of the RMB, it's very noticeable that it is being used much more heavily as a currency for trade than it is as a reserve currency, right? I mean, China, despite going into the SDR basket, and despite the freezing of other countries' foreign exchange reserves by, for example, the EU with Russia, for example, despite all that, the RMB makes up a tiny fraction of foreign exchange reserves globally, about 5%. Okay. But in trade, particularly where China is involved, it's much more widely used. China's own trade, about 40% is now settled in RMB, as opposed to US dollars. Globally, that doesn't translate into very much. It's probably, including third-party trade, it might be 7% of global trade. But that bit can change. And of course, that bit is hard to measure. But, there has been some progress. So just the other point I'd make about displacing the dollar, or the ambition to as a global reserve currency, I think China's, through the prism of the Communist Party's view of their economy, they would look at the historical precedents with some alarm, I think. That one of the constant refrains from party literature is that China must not deindustrialize too early, that losing your industrial base was a huge mistake that Western countries, and America in particular, made. That was a function of exchange rates. That was a function in part of being the global reserve currency. China doesn't want to see its exchange rate driven up to a level at which it is uncompetitive. And this is very much to do with the balance of interests between consumers and producers. In a sort of liberal market economy, the whole purpose of economic activity is to consume. you and I go to work in order to earn money so we can consume. In a sort of statist approach, the purpose of economic activity is to produce in order to enhance national power. And that's a very different mindset. So when you hear Americans debate the pros and cons of the dollar being the global reserve currency, despite the damage that it's done to their industrial base, the big retort, and it's a valid one, it depends on your priorities, is that, because the dollar is strong and because they are able to finance their current account deficits, historically at least, at low costs, at low interest rates, US consumers have been able to consume voraciously beyond their means.
And without much productivity, right?
Yeah, exactly. So from a consumption perspective, an overvalued currency is a boon. It means everyone else's labor is cheaper for you to buy, right? But if you're looking at it from a national resilience point of view, then clearly an overvalued currency is not the way to go. So that really is where the debates bifurcated, if you like.
No, this is fascinating. So in a sense, you're saying the U.S. is copying what China is doing right now, because the Trump administration has been saying, and, it would want to and have to devalue the U.S. dollars, and obviously wants to rethink the re-industrialization and how the U.S. needs to be a manufacturing power again, because it cannot just be a consumption-based economy. It needs to manufacture. At least some of the people who buy into Trump's economic policy do articulate in that way. What does that mean for the global economy? And more importantly, I think you're explaining of why China is doing those things in terms of using its currencies to help with its manufacturing and export. But it's not the same as what some would claim, that China is trying to dominate the global trading system or become a superpower over the US. And so why does that matter? Doesn't it make sense that every country is thinking from its own national interests? So why is that a problem?
Okay, and lots to unpack there. So with your references to the sort of Trumpian agenda on economics, I think a lot of the concerns that I've sort of raised here would go well beyond the sort of Republican MAGA clique, if you like, in terms of the export dependencies that the US had built up as a result of not paying attention to the impact of the overvalued exchange rate relative to China. I mean, it was Biden's administration that implemented some of the more potent industrial policy in the form of the CHIPS Act and the Inflation Reduction Act, etc. So I think it's a much broader awakening in America to the underlying decay of its economic capabilities. Where the US and China part ways in many ways is again through the prism of what the economy is for. In a democracy, in a liberal democracy, the economy is for maximizing economic welfare of the citizens.
Yeah, but since China is not, right? Since China is not, I guess that's my point. Why are we?
So the problem is that you have, on the one hand, half the world or more than half the world who are managing their economies for the economic welfare of their citizens. And in China, you have the second largest economy in the world and the largest measured by PPP basis that is being managed for the maximization of national power. And those two systems do not mix well. And that is why you have all these trade tensions and investment tensions and this sort of gradual bifurcation, I believe, going on in the global economy.
So what are you saying? I mean, again, for most people, they probably don't really care that much what China is doing in terms of its own economy for its own national power interests. How does that affect other parts of the world if you're saying their system cannot coexist with the other type of system, which is more of the US-led liberal economy?
I'll tell you how it affects you. I mean, presumably you use a smartphone. Presumably you're dependent on that and payment systems, and you're dependent on, a security umbrella, which depends upon a military. And the situation that the rest of the world has found themselves in now is because they haven't been paying attention to the trade dependencies that have been developed and cultivated by China, is that we can't rearm, we can't produce our own smartphones because we don't have a rare earths industry. And it doesn't stop at rare earths. We're entirely dependent on China for all sorts of specialty chemicals and things and these trade linkages are highly weaponizable. And that's what's been going on for the last year. We've suddenly woken up and, the writing's been on the wall for the last 15 years. It's been an inability of policymakers to actually execute on doing anything about it. But the reality is that if China wanted to, it could bring our economies to a grinding halt. And you see that in Europe with the auto industry. The auto industry is teetering on the brink, not part obviously because of Chinese competition taking their sales, but just from the production side, if the European auto producers don't get access to Chinese rare earths, refined rare earths, they can't produce anything.
Right. I guess what I'm trying to say is the way it's developed, the dependency on China and the vulnerabilities the West has over China, no one is forcing anyone to do that, right? It kind of just evolved to be this way. So what are you...
Well, the rules of the WTO made it evolve like that because the West thought that China had signed up to a set of rules which China just clearly ignored. China was pushing on an open door, but the Western countries didn't really hold them to account at WTO, partly because the WTO process is so cumbersome, and partly because the underlying assumption was that China would become a responsible player in time. So you're right, it's evolved like that. But it's evolved like that by the design of one party, I would argue, and by the ignorance, naivety, or inability to push back and execute policy on behalf of the other parties.
So what do we do moving forward? What are you advocating for?
Okay, well, I mean, what the point of the book was that because these two systems don't actually interact well at all, right? If you try, the West has a choice. It either becomes more like China, where you get a more statist economy, you get state intervention, industrial policy, and, with all the costs that come with that. Because remember, for all China's fantastic economic growth, okay, on efficiency metrics, it's, producing something of a basket case of an economy, right? In terms of incremental capital output ratios, in terms of per capita consumption, So even PPP adjusting per capita consumption in China, the average is below the poverty line in the United States, really. And that, of course, in part is because consumption is such a small part of GDP, because the state purloins the savings in order to invest for the purpose of just producing.
But China is also trying to boost its own domestic consumption, right? It's not like they don't want more consumption.
Don't believe that for a moment. I mean, China has been saying that it wants to boost its domestic consumption for at least the last 20 years, but it's failed. And the reason why it's failed is because of the structure of their political economy, which they don't want to change. So yes, if they could wave a magic wand and enhance consumption, they would do so. The low level of consumption is a function of the mercantilist construct of the economy. So unless you're prepared, and the party state aren't prepared to do this, is to say we will provide a much greater degree of services in kind to the mass of the population in terms of education spending, health spending, pensions, welfare, etc. And for perhaps understandable reasons, they don't want to go down the welfareism route. The alternative is to stop the financial repression, and so therefore allow people to allow market mechanisms to work in the savings pool and the allocation of capital, and reduce the savings rate that way in order to enhance consumption. All those policy measures go right to the heart of party control, and that's what they don't want to cede. They purport to want to raise consumption expenditure. They have done for a long time and failed to do so. And the reason for that is because the policy steps that they need to take in order to make that happen conflict with the party's own goals. So it's not going to happen, in my view.
The way you talk about domestic consumption, they're just saying it, they're not really doing it. From what I see on the ground, I kind of
So it was a
disagree
top
with that.
priority in 2009.
Some would argue the way the Chinese manages or controls its financial system is also a huge vulnerability. And that's also why China continues to have such a tight grip on its financial system, because it just doesn't really trust that liberalizing its financial market is actually good for the country or its people. So what do you see as the vulnerabilities in the current Chinese financial system?
Well, I think the key one is that the banking system year after year is compelled to lend out this huge accumulation of deposits into spurious, economically unviable projects that are being built not with a view to making a return on capital, but with a view to meeting some kind of production goal. The electric vehicle market is maybe quite a good one, or high-speed rail. These are good examples to use. High-speed rail is a state-dictated ambition. It's brilliant if you use it. It's not brilliant to own it. And so what you're seeing is more and more economically marginal high-speed rail tracks being built. Wonderful to use, but where's the return? And you see, the problem is that the depositors on the other side of the bank's balance sheet need a return. The banks actually have to pay the depositors, and they're paying them, of course, derisory low levels of interest rates on those deposits. So the key fundamental problem with China's financial system is, A, it's completely bank dominated. Banking system's about 3 times the size of GDP. The banks are taking money at very low deposit rates from individuals and companies and lending them out to companies who are struggling to service the interest payments, let alone the debts, repay the debts. And of course, you've had this evergreening where you just lend new money to service the debt for a long time now. And this is another reason why the whole replacement of the dollar argument starts to look quite tenuous, because if you were to liberalize capital accounts in China, you would see a large amount of capital looking to leave. So the state of the banking system is a key dictator of keeping the capital controls in place, in my view, and keeping the capital controls in place is a key determinant of the RMB's sort of the infeasibility of it replacing the dollar as a global reserve currency. That doesn't mean that the RMB cannot be more widely used as in an exchange currency, as in trade, for example. The speed with which that internationalizes, I think, is much more a function of genuine commercial attributes that the Chinese might bring to international payments in terms of efficiency and lowering costs. And that would come through technology. But how long they would maintain that technological advantage, obviously, is anyone's guess. So to my mind, the RMB's role initially was purely a defensive one to immunize China against the threat of US sanctions. If technology such as a wholesale central bank digital currency were to facilitate significant transaction advantages, then it might garner greater use. But one point I would make, and I think it's quite an important one in the light of recent events regarding things like iron ore and oil trade settling in RMB, is that one of the key determinants of the currency in which you want to trade those commodities is the existence of liquid, unmanipulated indices and derivatives markets in those currencies so that the producer can hedge. Here is something that China is up against somewhat, is that, it has tried to develop RMB denominated derivative markets in commodities that it widely trades in. But there isn't liquidity and there isn't the faith in the cleanliness of the prices there to entice people to adopt it wholesale without coercion. And so that is definitely something that needs to be watched in terms of the likely trajectory of RMB usage going forward.
What about the central bank digital currency, the ECNY? What are the motivations behind it?
So 2 points here. I mean, the ECNY, largely domestic, it's fiat money in digital form. It's commercial. It's a great commercial attribute. And Chinese citizens have demonstrated an aptitude and a willingness to adopt to new technology quickly. The ECNY will have a use as well in sort of tourism and internationally in a limited form. Much more interesting is the electronic payment digital currency, as in the central bank's wholesale digital currency, and how that interacts with varied payment systems going forward. But I think there is something to be said for it in terms of the efficiency and speed with which that can deliver international settlement and payment. And so that could be a significant feather in the RMB's cap as a trade currency. But one thing I would come back to here is that ultimately, if a country's national balance sheet is structured around a particular foreign currency. So, for example, in most of the global south, the overwhelming amount of national debt that is not denominated in their local currency is denominated in dollars. Then you need to earn dollars in order to service and repay that debt. So you might trade in RMB, but because that's what China wants or what have you. But when you get it, you'll need to flip it into dollars in order to service the interest payments on your balance sheet or to repay dollar debt. And so to some extent, the currency that you're prepared to earn or receive in return for your exports, it has to be convertible into the currency in which your liabilities are denominated. So, trading in RMB, great, but it's not, people will be very cognizant of the fact that they have these dollar liabilities on the other side, which of course brings us on to the very recent developments in terms of the redenomination of some US dollar debt into RMB by people like Kenya, for example. And this is an interesting concept and might well gather momentum, not because of economic coercion or geopolitics or anything to do with that, but simply because of the deflationary pressure in China and because of the financial repression in China, the interest rate structure in China has now dropped well below that of almost any other major economy, right? So it is cheaper to borrow RMB than it is to borrow dollars in terms of interest rates. But of course, the risk you run by borrowing those RMB is that if the RMB were to appreciate substantially, as market forces would perhaps suggest it should, given they've got $1 trillion trade surplus now, then obviously you'll be on the hook for a more expensive principal repayment than you necessarily thought of you would be when you agreed to the redenomination of the loan. So there is a trade-off here.
Well, if we look ahead 10 to 15 years, how should we judge whether the RMB is developing? What would it look like beyond just a trading currency? Are you seeing RMB gaining more influence internationally?
Yeah, so if you were looking for milestones and things that will pop up that you might think, this points to the ascendancy of the RMB. So I would look at third countries' national balance sheets, how they are structuring them, the degree to which people look to redenominate into RMB loans, also the degree to which China actually encourages or discourages that, right? Because, of course, there is potentially a vulnerability to China's financial system through this mechanism as well, right? But the second thing I'd look for quite closely is maybe Hong Kong. It is anomalous that the Hong Kong dollar is pegged to the US dollar. So we'd look re-pegging the Hong Kong dollar to the RMB. Maybe China would come and buy Hong Kong's US dollar reserves for RMB. I'm sure that would be controversial, but the repegging of the Hong Kong dollar would be a sign that China was perhaps serious. And then on the more positive side, dismantling the capital controls. I mean, if China were to start to dismantle those capital controls, it would send a strong signal that its financial system was healthy. That would facilitate the free movement of capital into RMB assets, and people would be assured that they could get their money out of those RMB assets when they wanted to, and that repatriation of the currency was not a problem anymore. These are things to watch. But then, of course, there's another side to the equation as well, which is the US dollar, right? So it's not just what China does and what happens to the RMB. It's also an ugly parade, if you like, between the other currencies that are competing for it. So what what to look for in the US dollar. Well, the US has an international investment position, a net international investment position now of minus 85% of its GDP. It's still running current account deficits. The dollar is overvalued on almost any measure that you care to look at. And therefore, there are big structural adjustments that America could make and might make that would help reinforce the dollar's role. But I fear that in the world that we're in, I don't see any sign that that the US will retreat from the use of economic statecraft to try and achieve its political goals. And so there is an incentive for third countries to hedge their position somewhat and not be too tied into any one system.
Probably biggest learning from me is I believe your thesis is that because of the way the Chinese political system works, most of the considerations economic policy ultimately is to serve the state's interests, whereas the US-led system is not quite the same. And so the two systems can't coexist. Is that right? That's what...
Two economic systems can't coexist or can't
Yeah.
interact deeply. Yeah. Not without huge problems.
Which is probably what a lot of people would say is happening right now, whether it's US-China or US-EU economic relationship. We're just seeing a lot of defensive mechanisms being built up or being considered right now in the EU. As Stewart Paterson argues, so much of the turbulence in today's global economic order stems from the West's flawed approach to engaging China from the very beginning. He contends that China's state-controlled political economy is designed to serve the interests of the party's state rather than consumers, and that it cannot easily coexist with a US-led market-driven system. From BRICS' push for de-dollarization, the rise in gold's prominence, the internationalization of the RMB, to the PBOC's digital currency experiments, and the Belt and Road lending architecture, the RMB is not yet trying to displace the dollar, but it has become an effective tool for Beijing to manage both risk and growth at home and abroad. This is Perspectives with Wenchi Yu, where we analyze the policies and political strategies of Trump 2.0 and their implications for Asia, China, Taiwan, and beyond. Thank you for watching and listening. We value your feedback. Please subscribe to our YouTube channel and podcast. See you next time.